Hello everyone, and I hope you all are doing good. And today we will be cracking the concept of fair value gaps, and we will understand that do they really work or not. So, before going to that, let us understand what is actually a fair value gap. As you can see, the three bars over here, so this middle one is the strong up bar, and usually it's accompanied with a nice volume down here, and you can see that there's a region which is not overlapped neither by the previous bar and nor by the succeeding, or you can say the next bar after that. So this price point which is having no overlap becomes a fair value gap according to the modern definitions. So let us see it in a price chart. So this is Nifty futures chart, which is a top index for the Indian markets, and this is the September futures contract. So as you can see, first the price consolidated over this price point, and then when the smart money or the institutional players decided to take it to the upside, they gave a nice healthy breakout with nice volumes down here. And you can see that if you will mark a fair value gap region, according to the definitions, it will come out to be this region. And in the future upcoming days, you can also see that how this worked beautifully and gave a nice upside to it. And let us see that how an old school trader, or like the one who just works on the concept of price and volume, you has to different approach towards this. So before this fair value gap thing became like mainstream and popular, I used to have a different concept named the concept of thin area, which is actually based on the volume activity at a particular price point or price range. So as you can see that this was the swing low, you can say, and this is the swing high. So from this point to this point, we will be using the fixed range volume profile. So if you will use this tool, then you will see the horizontal volumes, which will be defining that at this price point or this price range, how much trading activity or volume has happened. So I would like to first distinguish between what are the vertical volumes and what are the horizontal volumes. So vertical volumes actually tell you that how much trading activity has happened at that particular time point. Okay, so it's basically based on the time period. But the horizontal volume are basically based on the price point or price region. So how much trading activity has happened at this price point, at this price point, so like that. As you can see, that most of the volume has occurred at this price point, so you can consider this as thick area. I know you love thick things, so here you have your thick area at this point. So you can say that smart money or the institutional players, the average price of their positions that they would have taken must be at this price point or this price value. So let us move ahead and understand thin area a little bit more deeper. So when you applied this fixed range volume profile, you got this point where the least amount of volume has happened. Like this price point or this price range got the least amount of trading activity, as the smart money or the institutional player quickly moved the price away from this region. So you can say that the retail players or the retail traders didn't get any chance to take their positions at these price points, or they were unable to trade because the price moved so fast and so quick that they couldn't take any position and couldn't take any advantage of these price points, and smart money just quickly ran through this area. So let us see that why actually thin areas or the fair value gaps become important in our charting series. So this fair value gap or thin area serves as a pricing edge between the positions of smart money and retail traders. So suppose we got this thick area, and suppose this is a price point of $100 or 100 rupees. So the maximum positions of the smart money or the institutional players are at this price point, and it just moved from $100 to around $150, suppose, and then it came down to around $130. So what you can see is, if the smart money or the institutional players really wants to take it up, then it will never want the retail traders to take the position at the same cost or the same price that it has taken that position. So it will never want the retail traders to take the position at $100 or 100 rupees. So it will, this region will actually work as a nice barricade so that the retail traders couldn't get the price point of $100 or 100 rupees, so that there is always a pricing edge between the positions of smart money and the retail players. The next one we got is that thin area is like least accepted by the traders, or you can say the institutional traders. So they actually behave as strong supports and resistances. So as you can see, the trading activity is very little in this price point or price region. So you can say that the institutional players or the smart money is like, that smart money traders have this price region as the least accepted price points or price region. So uh, in at any cost, when the price comes to this region, they will uh, take the price to the higher price points, and this region will act as strong support and resistance zone. And next upon we have, with help from this concept of thin area, you can actually identify the valid fair value gaps and actually get a very nice efficient use of fair value gaps. You can see that in the market, many times fair value gap are created, but they don't act as they are supposed to be. So with the help of thin area, you can actually increase your chances to find efficient fair value gaps. And suppose you got fair value gap region as this much bigger region. So suppose the thin area, according to the concept of thin area, you got the price region where the least volume happened, just these places. So you can actually shift the fair value gap line to this. So now your region is narrowed down to this price point, so your stop losses will be less. And also, if I would like to add one thing, if a thin area is actually filled completely, or like we got a nice closing in that thin area, then you can expect that there was no intention of smart money or institutional trader to take that price up. It was just a trap, and now it's going to the toilet, down, straight down. So you can actually have a contra trade at that position if a thin area or a fair value gap, you can say, is completely filled, or a nice closing is happening in that area. It means that smart money is not interested in having any pricing edge between their position and the retail trader's position. So you can say that smart money was not interested in taking the price up at the first place. So you can be saved by that. So that's it for today, guys, and I think you liked this information, and I don't think that anyone wouldn't is giving such kind of information on the internet. So if you know Hindi, then there is a playlist of technical analysis that I have started, and it's actually from the scratch. Like in the very first video, I have thought about how to use TradingView actually. So if you know Hindi, then you can actually check it out and have nice benefits from it. So that's it for today, guys. I hope you liked it. Don't forget to subscribe, and that's it. Thank you.